All right, let's get straight to it. The market is completely locked up, stuck between the AI growth story and a looming government shutdown. Here's how we're looking at the next 2 weeks. So here's how we'll break this down. First, we'll look at the core conflict. Then we'll zero in on the shutdown catalyst. After that, we'll dive into sector divergence, map out 3 scenarios, and finally look at some risk-defined setups to potentially trade this.
Okay, first up, the core conflict. The reason the market is going nowhere is simple. You've got 2 huge opposing forces basically in a tug of war, and it's creating total gridlock.
And the conflict couldn't be clearer. On one side, you have the bulls, pointing to real hard AI earnings from big tech and some good news on the US-China trade front. But on the other side, the bears have a strong case too, focused on this shutdown deadline, and a Fed that's still very hawkish on inflation. You know, that Fed stance is absolutely critical here. Powell came out last week and basically threw cold water on any hopes for a December rate cut. The results? The 10-year yield shot right back to 4.1%. That's a huge deal because it rips away a safety net the market was counting on, and now there's a ton of uncertainty. So, to wrap this part up, you're looking at 4 main drivers: the shutdown crisis, a hawkish Fed, some positive trade news, and a real split in big tech earnings. You see strong results from some, weak from others. All this divergence means one thing: this is a trader's market right now, not a place for passive investing. All right, let's talk about this shutdown catalyst, because out of all those factors, this is the one with a hard deadline. It's the one thing that has to force a resolution one way or another. This is what's going to break the gridlock. Let's put some numbers on this. The first one you need to know is 42 million. That's how many Americans are at risk of losing their SNAP food benefits if this funding deadline on November 1st is missed. This isn't some abstract economic theory. We're talking about a direct, immediate hit to household budgets. And the second number? Just under $100 billion. That's the annual value of those benefits. So you pull a chunk of that out of the economy, even for a short time, and you're creating a serious demand shock. You'll see that ripple through consumer staples and retail almost instantly. So the next couple of weeks are going to be busy. We've got employment data, we've got more earnings reports, but the shutdown is the big one. It's a binary event. It either happens or it doesn't. And it's going to trigger a sharp move one way or the other before we even see that other data. Okay, let's look under the hood of the market now. If you just glance at the S&P 500, the trend looks okay. But when you dig in, the underlying health is, well, it's not good. Leadership is getting dangerously narrow. And you can see the divide right here. All the strength is concentrated in tech and semiconductors, your pure AI plays, and a few industrials. But where's the weakness? Financials, consumer staples, retail. It's a clear signal that the market is worried about the consumer and about interest rates. This chart really tells the whole story. The regular cap-weighted S&P 500, SPY, is being propped up by just a handful of giant companies. But if you look at the equal-weighted version, RSP, you see that the average stock is actually doing pretty poorly. This is not what a healthy, broad-based rally looks like. Not at all. Okay, quick pause. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. All right, so let's take all this information and turn it into some actionable scenarios. With the shutdown being the main catalyst, we can really map out 3 clear ways this gridlock could finally break. So the big question is, how does this all resolve? And the answer is simple. It all comes down to what Congress does in the next few days. Period. My base case is what usually happens, a last-minute deal. If Congress kicks the can down the road with a temporary funding bill, you should expect a relief rally. The uncertainty is gone. The posture here is to look at buying the established leaders. Think NVDA, think AMZN, on any dips. I'd be looking at a posture of about 60% long delta, 40% cash. Now, the bull scenario. This is a 1-2 punch. First, you get the funding deal. Then you get a weak employment report. That combo puts Fed rate cuts right back on the table and could spark a much broader rally. In that situation, it would make sense to increase risk exposure, maybe up to 80% long delta. And the bear scenario is just as simple. Total political failure. No deal gets done. That would trigger a sharp, risk-off move as everyone starts slashing their consumer spending forecasts. The posture there is defensive. You cut your net long exposure way down, say to 20%, and you start adding hedges right away. Okay, finally, let's look at 3 potential risk-defined setups that align with these scenarios. And remember, these are just structured ideas for educational purposes, not specific advice.
First, if you're bearish on the consumer, you could look at something like a put-debit spread on XLP. It defines your risk, and it plays that technical breakdown we saw earlier. Second, for the bullish case, maybe a call-debit spread on a leader like NVDA. It's a way to play a relief rally without risking a ton of capital. And third, if you just want to play the volatility of the event itself, an at-the-money straddle on SPY could work. It's designed to profit from a big move, up or down, after the news hits.
And to be perfectly clear, this is not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage your downside, and always verify all data.
So I'll leave you with one final question to think about. With market breadth this week, can the AI story all by itself keep carrying the indices if the consumer really starts to roll over? That's the key question, and how it gets answered will likely define the market for the rest of this year.